Okay, welcome back to part 2 of the WMS annual tax tips for 2014. Today we're going to run through tips 6 through to 10. Tip number 6 in our top 10 tips is the immediate write-off of plant and equipment for small businesses. Now from 1 July 2013 through to 1 January 2014, that threshold for immediate write-off for small businesses for equipment was $6,500. The government introduced legislation effective from 1 January of 2014 to reduce that to $1,000 for small businesses. Now that legislation went through to the Senate in March of this year, but it was not approved. It didn't get through the Senate, so I guess technically that means the threshold still stands at $6,500 for small businesses. However, what I do is I tread cautiously between now and the end of the year, because in all likelihood that legislation will be re-entered into the Senate for voting. And could possibly be approved. If that happens, the downside for small businesses is that the threshold for immediate write-off of assets will be reduced to $1,000, and that may well be backdated back to the original date as planned, being 1 January 2014. Okay, tip number 7 is the concessional superannuation caps for the 2014 year, and by concessional superannuation, we're really talking about the contributions to super for which a tax deduction is being claimed. Now for people up to the age of 60, so under 60, so aged 59 on the 30th of June 2014, that annual cap is $25,000. For people aged 60 to 75 at 30 June 14, that concessional cap is an annual amount of $35,000. So it's extremely important you don't go over those caps if possible, in order to avoid paying more tax. Now your employer super contributions that are made into your fund of choice by your employer, they're included in this annual concessional cap. So if you're looking to top your super up to the maximum level, you need to be conscious of what's already been contributed into your super fund this year before making that decision to top up. So any excess that goes above those caps of $25,000 or $35,000 potentially going to be taxed by the fund straight to your member account at the top marginal rate. And of course, as we all know, we've told you this many times before, to be deductible this financial year, contributions need to be received by the fund on or before 30 June, not after. So it's very important that you give yourself a few days grace to allow for the mailing system, the banking system, to make sure your super fund has received those contributions on or before 30 June. Okay, tip number 8 on our list of 10 top tips is the 2% increase in tax rate for high income earners. Now, as announced in the May budget this year, the government is proposing a levy of 2% for high income earners, so those earning $180,000 or more. That's to commence on 1 July 2014. And if what you read in the paper and the press is real, Labor are likely to support that proposal, so there's a very likelihood that it will be law very soon. Now what that means for you is where you've got an opportunity to bring forward the receipt of some income, you're going to be 2% better off if you can do that during the current financial year. An example of that might be for an employee who is due a bonus, a performance bonus at work. You may be able to start discussions with your employer to have that bonus brought forward in order to be taxed at the lower rates. Now on the reverse side of that, you may look forward to try and defer some deductible expenditure into the 2015 year. So if you were looking at potentially purchasing some equipment, or you had some work-related expenses that you normally fund in the month of June, you may look to defer those until July to claim a maximum deduction in the 2015 year, therefore taking advantage of a little bit more tax savings. Okay, tip number 9 is the increase in the Medicare levy percentage from 1.5 to 2%. Now that increase commences on 1 July 2014. That's going to affect all taxpayers, not just those in the high bracket. But when you look at that increase, together with the 2% levy we spoke of moments ago, that puts the high income earners on an effective tax rate of 49% for income over $180,000. Now this increase in the Medicare levy to 2% was a measure put forward by the former Labor government in order to help fund the National Disability Insurance Scheme. So it is law, it will happen, so it's very important that that is known now, because 1 July 2014 is obviously only weeks away. So as mentioned with the tip number 8 previously, some strategies you might look at putting in place between now and 30 of June will be obviously to bring forward some income, as we said, just in order so you're paying lower Medicare levy on that income, and where possible deferring some expenditure until the 2015 year. It's also important to note for our business clients that have a payroll function, now is the time to consider looking at your payroll function to ensure that the pay-as-you-go withholding tax rates for the 2015 year will capture the increase in this Medicare levy and the 2% levy for high income earners. And the last tip, and by no means the least tip, is the increase in the superannuation guarantee rate from 9.25% to 9.5%. Now this is effective 1 July 2014 and applies to all superannuation payments on behalf of employees. Now the penalties for non-payment and underpayment of the superannuation guarantee charge are personal and they can be substantial, so it's imperative that your payroll system is updated as of 1 July 2014 to capture this increase in superannuation to 9.5%. So there you have it. That concludes part 2 of our 2-part series on our top 10 tax tips for 2014. There's some old favourites amongst them because some things just don't change year in, year out. However, there are some new announcements, and the new announcements are the critical ones. 30 June is only just around the corner. So for any of these 10 tips, if you're not sure on anything, or you need further advice, or you need further discussion, as I said earlier, do what I do and talk to your accountant.